Peace, family. We're going to go over IULs and how to use IULs as a tool or vehicle for generational wealth. Now, this can be used with whole life vehicles as well, but in this example, we're only talking about IULs and how to use IULs and along with the trust to create that generational wealth that many families, such as the Rothschilds, have been doing for years. What they do is they make sure every child, every person in the family has an insurance policy. And they primarily use whole life. But again, we're using IULs. So for an IUL in this example, say you have a IUL policy that's been in existence for 20 years and maybe have a 7-year rate of return over that 20-year average. Here you have $100,000 in cash value, which is the amount that that person can borrow from while living at $100,000. Initially, the person had qualified for $300,000 or selected to be qualified for and was approved after all the underwriting of a death benefit of $300,000. So if they died that day, they have a total of $400,000 that both, say they had two beneficiaries, will receive. So for two beneficiaries, they'll have $200,000 for each beneficiary. Besides giving my beneficiaries a check, what I would do, or have my trust do, or trustee do, is instruct, after I deeded this maybe into the trust, or maybe the trust purchased the insurance policy, I'll have my trust give instructions to the insurance provider to maybe only cut them a $50,000 or $100,000 check out of that $200,000 that they get a piece. Why am I doing that? Well, for one, I'm making sure they at least have some form of expenses to take care of them, due to my passing. They may have, a lot of bills that may come up after I pass. So that $50,000 to $100,000 should maybe give them a little cushion. And I'll take the other $100,000 or maybe the other $150,000 and put it into an IUL that may be getting the same rate of return of 7%. This way, money never runs out. It continues to grow based on the interest here. Now, your money's not in the market at all. Okay, it's based on the performance of the market. And the number one thing is IULs and whole lives protect you from inflation as well as taxes. So not only would this money be tax-free money, it also gaining interest on the market at a 7% interest rate. Over time, that money will double. How many years would it take to double that? It's called the Rule 72. And you can do that on your own time. But this is how we create generational wealth. And hopefully, by the time you do pass on, your children are old enough and mature enough to do the same thing mom or dad did and have that same financial knowledge that mom and dad had when they got their IUL to get their children IUL, just in case something happens to them. Their IUL can fund their kids' IUL, and that way the child or that adult or whomever no longer really has to pay for insurance, because if, say, they insurance will be instructed to purchase a IUL or fund the IUL that's already existing, it'll be already fully paid once you put that lump sum in there, gaining interest on the market. So they're already fully insured. Insurance is paid up, considered self-insured at that point, and they're gaining that interest on the market. So if something happens to them, it does the same thing down here to their children, which will be your grandkids. Okay? This is how we continue generational wealth. If you want more information, contact me on Instagram at living equity _ministry, or at www.livingequityprivateministry.org, as well as Living Equity Private Ministry at protonmail.com. If you want to know more information, inbox me as well on Facebook at Teray Ali.